Today, what are households thinking now? Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, I want to go through some of the latest results from our household surveys, where we get a sense of what households are thinking, and specifically their plans relating to property transactions. This is the most up-to-date survey in Australia, and it gives very good forward indicators as to what we can expect to see in the next 12 to 18 months, and it fundamentally drives most of the research that I do. Now, just to remind you, our research universe starts with our household surveys, and those are running all the time. We have 52,000 households in our survey at any one time. And we pull other information from other sources together into our core market model. And our core market model then drives all the analysis that we do, all the way from our mortgage industry reports, our superannuation reports and channel reports, through to various banking and economic analysis, and even custom assignments for clients. And of course, it also drives the research that we post on YouTube and through our blog. Now, one of the critical things to understand about our surveys is, as we run these surveys each week, 1,000 new households, we put households into a number of different boxes based on their identifying criteria. And one of the critical ones is the Dfa Property Status. And here, we're looking at whether they are wanting to buy property, whether they are first-time buyers, whether they are existing holders of property, whether they're seeking to refinance, whether they're looking to trade up, in other words, buy a bigger place, or whether they're looking to trade down, meaning they're going to buy a smaller space, or whether they're property investors with one or two properties, or whether they're portfolio investors. And portfolio investors essentially have multiple properties, and in fact, the average portfolio investor still has more than 6 properties. Now, we have other overlays too, including geography and state, and also our master segmentation. But today, we're going to focus on the property status. Now, the first thing we're going to look at is the intention to transact within the next 12 months. This is a very important forward-leading indicator. And one of the things to notice is that portfolio investors and solo investors are now much less likely to transact than they were a year ago. This is continuing the trend that we've seen in recent times. Now, there are some down traders still looking to transact, and there are also some refinancers who are also looking for a better deal. But the first point I want to highlight is that demand overall for property, based on the expected number of transactions in the next 12 months, are considerably down from even 6 months ago. We can then ask about whether they are actively saving to buy a property. And there isn't a lot of change here. We still see that first-time buyers are most likely to be saving, and also those who are wanting to buy and hoping perhaps later to transact. And we also see those who are up traders looking to buy a larger place still saving to some extent. So other than the slight rise amongst first-time buyers, there has been very little change in terms of intention to save. Now, when we come to borrowing, this is the question: will you need to borrow more to be able to transact? There's been considerable changes recently, particularly relating to investors and portfolio investors. And you can see that the yellow dotted line and the solid dotted line have taken a real dive. Now, this is an indication that credit is, from a demand perspective, coming off the boil still. Now, it's worth highlighting that up traders are still looking to borrow more, and we've also got first-time buyers who are still looking to borrow. So essentially, there is still some demand for credit. But of course, as we'll see later, that demand is tempered by tighter lending standards now. Now we ask about house price expectations in the next 12 months. And perhaps not surprisingly, we've seen expectations dive in recent times, and that's pretty much above all our property segments. And including in there our property investors who have always been a little bit more likely to say that prices will rise. These scores here are the lowest that I've ever seen since running the surveys. And this shows you that the fundamental dynamic of the market has changed. Very few households now believe that there is going to be any rise in property prices in the next 12 months. Now, let's look across the barriers to purchase. Here we're looking at those wanting to buy. And of course, you see that house prices being too high is still there as one of the critical barriers. But the one that really stands out for me is now the availability of finance. About 40% of people who want to buy are unable to progress the conversation because they are unable to get finance now. Not surprising because, of course, lending standards are tighter. And let's look at that in terms of the current state. Fear of unemployment's 1.5%, interest rate rises 10%, house prices are too high 20%, overseas travel at 1.2%, the cost of living at 19%, but the availability of finance at 42% makes this the largest single reason why people are unable to transact at the moment. Now let's look at first-time buyers and why they might be considering purchasing. Why do they want to buy? Well, not surprisingly, perhaps it's finding a place to live. And there's also the question of capturing future capital growth. But we've started to see that fall away very significantly recently. And we've got to the point now where things like greater security and taking advantage of the first home owner grants where they're available have really kicked up. But interestingly, needing a place to live is significantly driving. Now let's look at first-time buyers and the biggest barriers to purchase. And of course, home prices being too high is there as you'd expect, although that's fallen away a little because the most critical problem relates to the availability of finance. In fact, nearly 50% of first-time buyers are struggling with that. And whilst things like the cost of living are also registering a little higher than previously, they're not on the same scale. And another way of looking at the current first-time buyer situation is home prices 24%, availability of finance 48%, finding a place to buy 6%, interest rate rises 6%, cost of living 13%, and the fear of unemployment 1.4%, and then other various factors, and just a very small relating to overseas travel. But of all of those, it's the availability of finance which is hitting first-time buyers the most, even now. It's also worth just looking at where first-time buyers prefer to buy. So 20% looking at city edge for units, 21% in suburban households, 26% for suburban units, 12% for the outskirts of town, and 18% are not sure where they're going to buy. Now let's turn to refinances and specifically ask the question, why would you refinance? And here we can see again that the idea of reducing monthly repayments is a critical driver. No surprise there, perhaps, given the issue with loan affordability. Other than that, there really hasn't been that much change, although loan rollovers themselves are a little less important than previously, and the search for a better rate is just slightly higher. Now let's look at uptraders and ask why they would purchase. Now these are people buying a bigger property, so the first thing is for investment purposes. Now that's really started to drop away, and now more space is the main reason why uptraders will purchase. And it's also supported by lifestyle changes and also moving with a job. But the whole concept of taking a property and getting a bigger one for property investment has taken a significant dive. And we can look at that again on this pie chart, which shows that 41% are looking for more space, 16% are moving with job changes, 22% are now looking for property investment, 20% for lifestyle change, and 1% for other reasons. Now let's look at downtraders and again ask the question, why transact? So increased convenience is one of the reasons why people are looking, but also its release of capital for retirement. And in fact, that is by far now the main reason why people want to transact. So they're sitting on equity and they want to release some of the equity before prices fall further. The other reasons, for example, switching to investment property is now considerably less important than previously. And things like unemployment and the death of spouse or other reasons are roughly where they have been before. But for me, the most interesting issue here is the significant demand to release capital for retirement before home prices slide further. So here is the current motivations: 50% for retirement capital, 30% for convenience, 10% for illness or death of spouse, 1% for employment, and 2% for other reasons, but only 6% now considering the need to switch to an investment property. We can look at all investors and their motivations, and what we see is that whilst appreciating property values used to be a very considerable driver, that's really fallen away. It's still regarded as a tax-efficient investment, and that's now one of the main reasons why people are considering property investors. But the whole question of capital gain looks to be off the agenda. But there is still of the thought that there are better returns than deposits. Now, in practice, my view is that, in fact, in many situations, investors are underwater when you look at the total cost of managing the property, the net rental returns, and the costs of mortgages. However, in our surveys, many property investors had very little idea as to what their true return pre-tax was actually, and they were really reliant on the tax breaks, thanks to negative gearing and capital gains, to make sense of the proposition. Now, turning to investors and the barriers that they're facing, and perhaps not surprisingly, we see the changes to regulation being one of the most significant factors that are driving behaviour, as well as the question of can they get finance and the fact that they've already bought. It's worth noting that warnings by the RBA hardly have any impact on these households. Now let's look at solar investors and why they're transacting. There are two reasons mainly: one, tax efficiency, and the other is better returns than deposits. And really, there's been very little change on those fundamental drivers. But the other one, appreciating property, has taken a real nosedive. Almost no investors now are considering property as a good place to appreciate value. That's a significant change from, let's say, 2 or 3 years ago. And now let's look at superannuation property and why they would transact. Somewhat similar arguments. Tax efficiency, of course, stands out. But again, the concept of appreciating property has taken a significant dive from previously. And there is still some evidence of leverage and the value of leverage being appreciated by some superannuation holders. Now, we can also look at where self-managed superannuation trustees get their advice from. And this is probably quite worrying, because what it tells us is that internet forums and sites, the light blue line, is the most significant source of information. Mortgage brokers, who used to be quite popular up until the middle of 2017, have taken a significant dive. And people also rely on their own knowledge. Some do touch financial planners for information and real estate agents and accountants, but it quite astonishes me that people go to internet forums and sites to get information about superannuation. Now, here is a plot of the share of self-managed super funds in property for those with self-managed super funds in property. And interestingly, mostly it will be those with 20 to 30% or 30 to 40% of their superannuation in property. There are a few with significantly higher holdings. And it's also worth noting that there's been very little change in recent times, despite the fall in property values. Now, another thing we can look at are the consumer purchase drivers by segment. And what's interesting is that pretty much all segments will trade off a bunch of different requirements, but price is still the most critical element. That's pretty much across all of the segments. In most cases, it's around 80%. There is a difference amongst holders who are more likely to be influenced by brand or loyalty or trust or flexibility, but pretty much all other consumer groups are fundamentally driven by price. Next, we look at the use of mortgage brokers. And actually, there's been very little change over recent times, other than more households are looking to refinance, are a little more likely to use mortgage brokers now, and that there's been a drop-off in both solo investors and portfolio investors' use of mortgage brokers. That's really because less of these particular types of households are looking to transact at the moment. So if I stand back and just think about what all that data tells us, it's firstly that the whole concept of capital gains and property value appreciation has been shot at the moment. Most people believe that property is not going to increase in value. That's a substantial change from even 12 months ago. And that means that the demand for credit is already coming off the boil because less people are transacting. And then we've also got the other factor that lending standards are significantly tighter. So it's more difficult for many households to be able to get credit. And that goes back to my standard argument at this point, which is the reason that home prices are falling is because demand is weaker. The reason that demand is weaker is because credit is less available. In other words, the credit impulse, once again, is impacting behaviour. Now, we're going to update our survey results in coming months, but already this updated information, which is right up to date today, will go into our next scenario modelling. And we're going to talk about that scenario next Tuesday in our live stream. That's the 19th of March at 8 p.m. Sydney time. So if you want to join that, the link is here. You can also send me questions beforehand via the DFA blog. Links are in the comments below. Or join me in the live stream for a live chat. I look forward to meeting you there. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.